Good day. Ira Epstein with your SPDR ETF video, and we are now on Tuesday, the 31st of March, 2020, just after 4:30 p.m., and this is Daylight Standard Time, DST. Look at the sea of red behind me. Coming to the end of a quarter, the end of a month, all this bad news about to hit us again. Remember what we talked about? We had that Monday up and then the reversals today. It's a hard cycle for traders to deal with. We saw Goldman Sachs come out with reports where they're looking for unemployment to surge to 15%, but if you looked at the St. Louis Fed, they were talking 30% unemployment very shortly. GDP taking a hit. We'd expect all that. The question is getting through the virus. We heard the president talk about infrastructure programs. I'm not sure that anybody wants to talk to him yet for the stimulus. This is the relief program that's just kicking in. I think you have to get beyond that to get the stimulus talk, so I'm not expecting anything there. As we take a look at the technology sector, Spider, you can see how the market got this nice rally up. Now the question is the market ready to stall itself a little bit? As we come here on the swing lines, the swing line has a pattern of higher lows and certainly higher highs. That means the market's in an uptrend. That trend would be broken if the market gets under 78.25. When you look at moving averages, the market came from the depths down here, and we'll take a look at Bollinger Bands in a moment, back and fought a battle at the 18-day average, tried to get up today and away from it. The question is, can it stay away? The bulls have control on this chart because the bias is up when you're over the 18-day average and the swing line is up. The number not to be taken out is 78.25. If you look at the lower Bollinger Band, you had run it, and then as you can see, just past mid-month, the market started that rally, and it has continued on. Now the question is, what does the market do with new deployment of money that's going to hit the marketplace starting right away? Is money coming out, staying in? People will see the numbers at the end of the quarter. What do they want to do? As we look at momentum, the slow stochastics are now, with a reading of 70, overbought. So even though I'd look normally and say, okay, the 18-day average might hold that market. When you're overbought, what I've learned over time is, especially when neither number is ready to embed, be careful. Even though the bulls have some control here, the market is overbought. As we take a look at SMH, which is the 25, it's an index of semiconductors are the 25 biggest ones, I guess you'd call it. You've got the higher lows, but now you could be making a pattern of lower high. The battleground, just like we were looking at in the XLK, seems to be the 18-day average. And again, I have a market that's smack in the dab of overbought after a big rally. I'd be very cautious. Was that just about it? In the XLI, I'd be careful here. If you take out 57.97, you end up with a pattern of potentially lower highs, lower lows, which is bearish under the 18-day average, bias down, and the market has had a run here. It's not overbought, it's at 64, but that would definitely give the market some divergence if momentum continued to point up. That could turn the market bearish. So if the bulls are going to try to defend it, and they haven't been able to, all you've done is get to the 18-day average, they could lose control quickly, in my opinion, if you got under 57.97. As we take a look at the next chart, which is the energy sector, you've had this run up to the 18-day average. That's about all that I was looking for when you lost the embedded reading. Now the embedded reading, if I can get this to work right, here we go, I'll be able to back it up. This is an embedded reading. It's when both numbers are, and let me go one more day, both numbers are traveling under a 20 level. When you lose it, unless that number gets back under 20, the red line is called the K line, my theory is that the market's going to make a run towards the closest moving average. And it's a combination often of the average dropping a bit and the momentum picking up. And that seems to be exactly what was happening. Price momentum was climbing. Often it culminates at that 18-day average. Now, in this chart as well, if this market now takes out right here, this 2709 level, and doesn't take out the 31 level, then you turn the trend. Then you'd have lower highs, lower low. You've corrected an over sold condition. When you come out of a bearish embedded reading, the first thing you become is oversold. And to work out of that, you've got to get both numbers, in my theory at least, back over the 30 level. When we take a look at QQQ, you've had this run up. You're overbought as can be. You've gotten away the first day today of not hitting that 18-day average. It'll be interesting tomorrow what it can do. I look at the resistance between the 18-day average and the 200-day average as key numbers right now in the marketplace. There's another thing. When I'm looking at this chart, if you did a Fibonacci study from this high to this low, you're probably, and I'm just guessing mentally, at about a third of a retracement. I'm going to do tomorrow for the futures markets, because I think these markets all just look at what the futures are doing anyways. I'm going to look at the futures and try to do a study of just Fibonacci's in the major indices along with the VIX to give people some ideas to what's going on. I'll talk about that tomorrow as I get it all finished. When we take a look at the Emerging Market ETF, you've got a pattern of lower highs and higher lows. That is not a trend. The battleground had been until today again, hitting that 18-day average the past several days, and again you are overbought. Can this market turn its trend down? If you get under 5204, the answer is yes. That would turn the trend down. Then you'd have to get back over this high up here. And if that starts down again, the question is, do you make a run into that base area that the market had done? In the gold market, I had talked in my futures edition today and last night for my traders that if the market in the futures got under 1612, I'd have been careful. That would have broken a pattern of higher lows, higher highs on the futures. And now what you've set up is a bearish chart on the GLD. You've got lower highs, lower lows. The momentum, well, actually, it's the bias, I'll call it first, is down, and momentum is trying to turn down. Everything seems to be pointing that this market's trying to make a run to the downside. First support, 145.10. What throws the theory off? If the market can get back over 154.81, you'd break this pattern of lower highs, lower lows, and you'd certainly be back over the 18-day average of closes. In the gold miners, it's a bit different. You have been fighting out of the past 1, 2, 3, 4, 5, out of the past 6 days, 5 days hitting this 18-day average of closes. Momentum is waning to the upside. You can see it's starting to try to move back down, and the swing line is up. You've got divergence here. You've got the higher lows, higher high pattern. Yet the bias is down because you're under that 18-day average. I don't see anything on this chart. TLT, overbought as can be. That's the first thing that I look at. Then I look at this market that we had this monstrous run-up, as you can see. Was this the secondary attempt to get back there? And maybe the Fed action where it's opening its new facilities where central banks can step in and they don't have to worry about selling U.S. securities to get dollars. They can borrow them from the Fed. That takes place right now. So a lot of things are changing right in front of us. The Fed is very aggressive, and they're trying to halt, I think, the rally in the dollar, the shortage worldwide of dollars. Certainly going in the month end, that was an issue. In the euro currency, if we take a look, you can just see the spikes. You got lower highs. You certainly have a low that's under a previous one. You rallied into the 18-day average, the 100, just missed the 200, and have broken back. So what is the trend? It is still down. I think the pros are aggressive on the short side in this area here. I think that they would possibly change their opinion if the market got over 105.21. The problem is if it gets over there, do you want to buy into a 200-day average? That's often a big number that traders look at. So you put it all together, you try to come up with a game plan. I'm going to try to get one for you tomorrow when I do these the Fibonacci indices. They just announced that Chicago's in a lockdown now again until April 30th. So I'm going to be home for a very long time. You're not allowed to go to the offices or anything you don't have to do. I'll pay attention. I'm Ira Epstein. I wish you all the best, and I'll see you tomorrow.